Hi, everyone, and welcome to the second Eureeca webinar. Today we're going to be talking about valuation, as Hayden just told you, and we're going to divide it into three primary sections. The first, we're just going to be talking about the theory behind valuation, what it is, what's important to know about it initially. Then we're going to be talking about the four most common methods to value your business. We're going to be stopping for questions after the first two methods, because they tend to be the numerical heavy ones. And we're going to be stopping for questions again after the two theoretical ones. After that, we're going to stop for a fourth and final Q&A session after just a few closing notes. So to start with, let's talk about what valuation is. There's a lot of stigma surrounding valuation, but the bottom line is that your valuation is the price point of your company. It's just whatever the total price is. This tends to be in relation to how much you're raising. So for example, if you're raising $100,000 and selling 10% of your company, your valuation is $1 million. And a very important note that we're going to be coming back to quite often is that your valuation is worth whatever an investor is willing to pay for it. It's just the market price of your company. Now, let's talk about when you should be looking to value your company. With early stage businesses, this tends to be very static, as in you would only value your company at specific points in time, typically when you are raising money for your company. So ideally, you want to value yourself when you are deciding to raise money, and once you know roughly how much you're looking to raise. The amount that you're looking to raise tends to determine your valuation. An important note that all entrepreneurs should be looking at is that you want to raise just enough to achieve your next milestone and then come back with a higher valuation. What you don't want to do is raise too high an amount right off the bat, because your valuation would be equally high, and it's very difficult to raise funds for such a large valuation. You also want to be approaching the negotiation table having had a rough idea of what your company is worth. And the methods that we go through today should help you with that. Now, valuation tends to be, as I said, very stigmatized. It's a very scary topic. People want to know how much they're worth. And really the reason that valuation is so difficult is that it's more of an art than a science. And you're going to be hearing that statement a lot. Unfortunately, there is no one definite method that will give you an exact number of how much you're worth. It's not very pleasing to hear, but it's just we're not that advanced, especially for early stage businesses. However, there are a lot of methods that will give you a rough estimate of what your company is worth, and we're going to be going through a lot of those today. What also tends to affect valuation quite heavily are the market factors. Namely, they are the market, how the market's doing, the industry comparisons, company performance, etc. To give you an example, if you were running, let's say, a social media company back in 2004, before the idea was properly popularized, you wouldn't expect to receive as high a valuation for that as you would if you were to do it today, or let's say a couple of years ago, back when Facebook was IPOing and it was all the rage. So it's very important to look at the factors to determine your valuation before you decide to value yourself. Also, valuation tends to be quite difficult, especially for the entrepreneur. I mean, trust me, I'm very sympathetic to this, because this is your baby. This is something you've been raising from the start, and you're effectively putting a price stamp on it. And you're having people tell you you're wrong, or potentially that the company is not worth as much as you think. And it's not a very pleasant conversation usually. So we understand it can be quite difficult. And for early stage businesses specifically, the things that hamper your valuation tend to be a lack of historical data, a lack of effective comparables, and a lack of proof of concept. And we're going to be talking about effective comparables a bit later on, but really what it means is that there aren't a lot of businesses that are raising money at that specific point in time that are exactly like your businesses. So it's really difficult to just point at a company and say, oh, well, I'm worth that. Really, a lot of valuation comes down to negotiation. Because there aren't surefire methods that give you a valuation or give you a specific number that says that's what you're worth, what it comes down to is just proving to the investor or the listener how much you think your company is worth, and that tends to be based on your future potential. Ultimately, the market wants a winner, and it's your job to convince your listeners and your investors that you're worth what you say you're worth. The bottom line is you need to be reasonable. You need to come up. There's no point in you valuing yourself at such a high number that no one invests in you. You want to prove that you're worth as much as you are, and you want to come up with a number that will actually get you the investments that you're looking for. We're going to stop for a short Q&A. Are there any questions?
We've got a question from the, in the comments section that is, as a partner, can valuation be used to withdraw from the business to run another one?
So are you saying that can you withdraw the money that's been invested in your business to fund another business? If so, the answer is no. I mean, if an investor actually invests in that business, then it's your duty as the entrepreneur to only use the funds for that specific business. Because that's what they invested in. They didn't invest it for you to, they didn't give you the money personally. They didn't invest in the entrepreneur. Always invest in the business specifically. And you cannot be using that money for any other project.
Does anyone else have any questions at this time? You can use the raise your hand feature to ask. All right, Omar, you're good to go to the next section.
All right, thanks, Aiden. So now that we've talked about what valuation is theoretically, let's talk about the primary methods to value your business. We're going to be talking about 4 primary methods today: comparables, discounted cash flow, cost to duplicate, and the Burgess method. Now, the first 2 tend to be quite heavy numerically. They require a lot of numbers, they require a lot of theory, and thus are a bit more difficult to create. The second 2, the cost to duplicate and the Burgess, are a bit more theoretical, but they also tend to be a bit less accurate because of that. We're going to stop for questions again after the comparables and the multiple and the DCF. So the first method we're going to talk about is the market multiples approach, or the comparables method. The market multiples approach, ideally what you're doing is that you're looking at comparables in the market, companies that are similar to yours in size, scope, industry, operations, and you're saying that you're worth whatever they're worth. The good thing about the market multiples approach, and the reason it's my personal favorite, is that it provides validation. Now, we as human beings love validation. We love that, we love knowing that someone else agrees with us. And just being able to point to a business and say, well, VC XYZ invested in it at that price, and I'm quite similar to that, would lead me as an investor to be a lot more agreeable to what you're saying your valuation is. And yeah, that's why it's also a VC favorite. It's just a lot easier to agree to things like that. Now, I'm going to talk to you briefly about how the method works. I'm not going to go too deeply into it, just because it can be quite detailed. But I will provide you a short overview just so you understand how it works. Now, first, you want to pick the comparables. These are the companies that are really similar to yours and operate in a similar way. The closer they operate, the closer they are, then the more accurate your numbers. You want to pick about 4 or 5. Once you do, you want to get a ratio. Now, EV here stands for enterprise value, which it's just the valuation of the company. And these are easy to find because any article that you find naming these will undoubtedly list the valuation. Sales refers to the revenue, and EBITDA refers to the earnings that the company made before tax or depreciation. So what you do is simply find the comparables, as per the example here. You'd say, okay, well, company A has sales of $500,000 and a valuation of $500,000 and earnings of $100,000. You do that, and then you just calculate the ratios for each case. After that, you just get the average of each and multiply them by your own earnings or your own sales, depending on which ratio you choose to use. Now, the idea behind this is that since, I mean, I'm going to be repeating this a lot, but since someone else validated this company at that price, your work's cut out for you. You know that someone has done all the work, someone's done the research, and they're happy with that price. Therefore, your investor should be as well. The advantages of it are that it's very accurate and it's very indicative of market demand. The fact that an investor has invested in it shows that they believe in its potential, and therefore it's very easy to argue that case. Unfortunately, the disadvantages of it is that it's very difficult to find comparables, especially as most early stage businesses tend to be private companies. Private companies, as you know, aren't required to disclose their figures. Therefore, just finding this data can be quite heavy. But if you do find it, then you're in a very good place when valuing your business. The second method we're going to talk about is the discounted cash flow method, or the DCF. Now, the DCF assumes that the value of your company today is equal to the present value of the cash flows discounted back at that rate. In English, it just means that your company is worth today what it can potentially achieve tomorrow. Excuse me. The DCF relies on what we call the time value of money principle. It just assumes that $1 today is worth more than $1 tomorrow. As in, I would much rather have $1 today, invest it, and get a return for it than I would to just receive $1 tomorrow, because you can simply achieve more with it. Now, this formula looks quite scary, but I'm not going to go into it. But really, this is what the DCF formula boils down to. You're just going into future cash flows discounted back to today. If you use the Eureeca site or just any other method, we are going to give you templates that solve this, as will most people you go to. So you almost never have to worry about this particular one. Really, the methodology of using the discounted cash flow is quite simple. The first step is for you to forecast your projections. What that means is that you're going to look at your company and you're going to see how well you can do in the future. What are your revenues? What are your expenses? And what are your profits and losses? Now, the more historical data you have here, the much more likely your future projections are believable. Now, I see a lot of projections every day here at Eureeca, and really, it's difficult to buy into numbers that tend to jump too high or just don't have any backing behind them. For example, if we look at this one, a jump from 5,000 to 75,000 in a year is believable, especially for a startup company. However, if you have zero revenues in 2014, this is assuming, by the way, that we're starting at 2015. But if you have zero revenues in 2014 and projecting $1 million revenue in 2015, that's a lot harder to buy. So the goal here, as with the valuation metric that we talked about earlier, is to be as realistic and down to earth as you can, while still being relatively optimistic. Now, after you've got your financial projections, the second step is to determine the discount rate that you're going to be using. Now, this discount rate represents the return that you're promising your investors, or not promising, the return that your investors are expecting to receive by investing in your business today. For early stage businesses, this tends to be anywhere from 20 to 50%, and it increases the riskier or the more issues that a business has, and decreases the later on you are. Essentially, the higher the discount rate, the lower the valuation. Finally, you apply the formula. Now, this Excel sheet here it's a template based on the formula that we skipped over earlier, and out comes valuation. Now, second to the multiples method earlier, the discounted cash flow is one of the most commonly used ones, and it is one that is a personal favorite of mine. Simply because when you have when you actually take the time as an entrepreneur to map out the projections, to map out the revenues and expenses and cash flows, what you're doing is that you're telling a story with these numbers. You're telling the investor how you see the company growing in the future, 3, 4, 5 years down the line. And that tells me a lot about you as an entrepreneur. It shows me your plans. It shows me that, oh, in year 5, I want to expand to Saudi Arabia, for example. I'm planning on doing all these amazing things. And with your investment, I'll be able to accomplish that. And really, the benefit of it is that it allows a company to value itself based on future potential. Now, I, as an investor, what I really care about is what you plan on achieving in the future, especially as an early stage company, rather than the year that you've done. Now, don't get me wrong, the past historical year is very important because, as I mentioned earlier, it backs your projections. I'm much more likely to believe that you can, let's say, achieve $500,000 in a year's time if you've already achieved a quarter of a million. But the benefit of DCF is that it takes into account future potential and it shows me how you as an entrepreneur think. The primary disadvantage is that it can be a very volatile method. For example, if you overvalued yourself during your projections, by halving them, I've essentially halved your valuation. And same with the discount rate. Small changes in either can drastically affect the number that comes out at the end. And of course, forecasting can often be inaccurate because none of us can predict the future. All right, we're going to stop for a short Q&A. Does anyone have any questions?
Hey, Omar, just a note, a couple participants have asked you to raise your voice slightly if possible. Does anyone have any questions about the first two methods that Omar addressed? If not, we will just continue. Alrighty, I think you can proceed, Omar.
So the first two methods have been the heavily numerical ones. Hold on, I think we might be having a question. No, all right. So the first two methods I mentioned were the heavily numerical ones. They were the ones where that rely a lot on data, a lot on numbers, and thus they tend to be good for later stage companies as well. However, there are other methods, and the ones I'm going to talk about now tend to be the more theoretical ones, the ones that are used more commonly by angels, for example, or really idea or prototype phase companies. The first one we're going to talk about, or the third method today, is the cost to duplicate method. Now, this method assumes that a company is worth however much it would take to duplicate it. It's pretty self-explanatory. The idea behind it assumes that no investor will be willing to pay a price for a company more than what it would cost them to recreate it themselves. Now, let's assume, for example, that we're a shoemaking company. We wanted to value ourselves based on what we've done in the past, where we stood up until now. So we say, okay, well, we spent 18 months in development, costing us $250,000. We spent $50,000 on equipment and $150,000 on labor costs. Therefore, it would cost $450,000 to duplicate my business. Therefore, I should not be valued less than that. And an investor shouldn't pay less than that because that's how much it cost me, and presumably it would cost someone else. An example of this is actually the Yahoo purchase of which was bought for $164 million. The idea behind this was that Yahoo assumed that it would take them 18 months to build a site with Arabic functionality. Therefore, they would actually be much better served to purchase a business that had already done this. Now, while this method is rather easy and quick, it unfortunately isn't very reliable and is not one that you'll see a lot on Eureeca. Simply because just walking in with this isn't enough. It doesn't show that you've thought about through your valuation enough. It doesn't show that you really address the potential of your business, and that's really the biggest flaw in this method. It doesn't take into account what your business can become. It only looks at what was accomplished in the past. Our fourth method for today is called the Berkus method, or the stage method. Now, this method here, company based on relative criteria. It assumes that the more the company's done, or the more boxes it's ticked, the more value it has. This is often used by angel investors, and it's a rough and ready method to value your company. What you would do is that you've got 5 main criteria: the quality of the management team, the soundness of the idea, whether there's a working prototype, the quality of the board, and any product or rollout sales. or product rollouts or sales, excuse me. What you would do as an investor or as an entrepreneur is that you would look at your business, you try and value it objectively, and you'd assign a value of $0 to $500,000 for each of these criteria. So, for example, if you have a really robust management team, you've got really strong people behind you, then you'd give yourself $500,000. If they're only okay, they're just fresh college graduates, they're good, but they're not as experienced, you might give them 100,000 or less. What you would do then is that you would add up all these numbers and you'd come up with a valuation for your company. Another form of the Berkus method could simply be a chart like this one, where you'd have certain criteria for the business. For example, it's at a business plan stage, or it's a prototype ready, and you would value the business just based on how many boxes it's ticked in this way. Now, the advantage of the Berkus method, just like the cost to duplicate method, is that it's quite easy. It's a checklist method. However, it is overly simplistic and generic. And like the previous method that we talked about, just walking in this in front to an angel investor or even just coming onto Eureeca with this, it will not be enough to get you funded, simply because you need to show something a bit more robust, something preferably a bit more numerical, like the DCF or the multiples that we talked about before. However, the advantage of both is that they just give you a ballpark approximation of what you're worth, and they just give you a better idea and a better negotiation tactics when you're dealing with investors or otherwise. And we're going to stop for another short Q&A. Are there any questions?
I think we have a couple questions coming, Omar, in the comments section. People are busy typing. John has a question. Go ahead, Christian, as soon as you can reach out. We have Anas Al-Kawasmi coming live from Zinc in Jordan. We're just waiting for his microphone to connect. So Sefwan has a question, Omar, from the comments section. If I evaluate my management team to 500K, how to ensure that investors make sure that my valuation is correct?
So one boils in that it all comes down to negotiation. It all comes down to whether you can convince an investor that you are in fact your management team is in fact worth $500,000. What you would do is that you'd share your CVs, for example, of the management team. You'd share bios, and you just tell them why you think they are worth that. And then hopefully you'll both come to an agreement. I think you're still on mute.
Yeah, started mic on. Okay, so we have a question from Novell. For a business that has been running for 1 to 2 years, for instance, should we take into account the cash position of the business in our valuation?
By cash position, I'm assuming you mean flows, and really, yes, you definitely should be, because this goes back to the DCF that I mentioned a bit earlier. Really, the cash flow that you have or the revenues that you've made, they provide proof or just backing that your company is able to achieve more revenues in the future. It shows that, look, I've accomplished X in the past, therefore I will be able to achieve Y in a year's time. Therefore, absolutely, you should take them into account, and you should be very proud of them.
Okay, so we have a question from Anas now. If these methods, and I believe he's referring to the last two, are generally not used by Eureeca, when would they ever be used?
And that they're not used exclusively by Eureeca. Now, they're very good methods because they give you a rough idea of what your company's worth, but they should not be used exclusively. As in, you shouldn't just do a Berkus method, for example, and assume that everyone's going to believe you, because there's going to be a lot of back and forth, and you're just not going to be able to negotiate that price summarize as much. Where those are good is that they just give you a rough idea. For example, you think that, okay, well, the Berkes says I'm worth around 1.5 million. Therefore, I'm going to use other methods, and that's actually the next slide, to show why I actually think so, just to support your argument. So they shouldn't be used alone, just to summarize. They should be used concurrently with other methods.
And Dina has a question that I think we can maybe move to the next Q&A. It's, do all methods yield the same valuation of the company in the end? Maybe that's best for the next section. And we have another question from Harish. How is the valuation of a new startup done in the first 6 months? How does an investor know if it's rightly valued?
So Harish, this comes back to what we were saying originally, just regarding what the market sees this company as accomplishing, or sees the company accomplishing. It all comes down to the potential of the company. It comes down to things like the management team that the Berkes method talks about. But really, what you're doing is that even though this company is really early and then therefore doesn't have as much historical data or concept, perhaps, you're looking at what you think as an investor be able to accomplish 5 years from now or 10 years from now. Will you be able to make 5, 50, 100 times your money from this business? Do you believe in the idea? Do you believe in people running it? And just various elements like that.
And Harish has an add-on question. He says that some of the experts say that it's more important to keep increasing the valuations rather than the income. Give your input on that, or your opinion on that statement.
Well, good point. Simply because a lot of people tend to assume that valuation is tied with income. But if you look at what we've seen in the past, where, for example, Dropbox was valued at a very high amount, where it has very few revenues, we don't seem to be following that trend. People could, you as a user or as an investor, could see that the database of a company is much more important than the dollar value it's being able to generate. So you might value it a lot more just simply for that. So no, I don't think income is necessarily tied to valuation, but a company that is generating a lot of income would ideally have a decent valuation as well.
Okay, so we have another question, Omar. We are valuing a company and prima facie looking at the asset-based approach. We can see the value is negative. We still feel that the business has potential. What will be the best method for valuation?
In this case, because the asset-based approach, which is actually quite similar to the loss duplicate method, the main flaw in this method is that it doesn't look at the potential of the business. It only looks at what it's accomplished in the past, or what, in this case, the value of its assets are worth. So really, I agree with you. Just because the asset approach says it's negative doesn't necessarily mean that it's negative. I would suggest you look at the potential of the business, you look and really value it based on that. So the DCF method, for example, would be quite good here, and the multiples method even better if you could find decent multiples for the business. Really, I would suggest, as for every valuation method, to try and find a mix and match of as many methods as you can, and just get an average of the valuation.
Okay, so we have a question from Novell. How do we value our intangible assets, for example, brand and IPs?
That's a really good question. Intangible assets, it's like brand or IPs, are actually a lot more difficult to value simply because it's more difficult to value something that's not tangible, as the name implies. I can't help you with an exact number. What you would do is that you would assign the value that you think is reasonable for them, and it boils down to a negotiation element with the investor. Whether the investor agrees that they are worth as much as you're saying they are. But they definitely should be counted in any valuation. And when you look at things like the DCF or comparables, a lot of investors do count them when they are taking valuation count.
Okay, so Rod asks, if we have a unique company, R&D, with a growth rate and turnover of about 25% for 7 years, its sales about 1 million, what is the best way to evaluate the company?
Again, I'd suggest a mix and match as you can find. So with a company like that, it seems like it's got decent historical data. Therefore, the company should be projecting the 3 or 4 or 5 years down the line, having financial forecasts to show you how they think they're going to be expanding. And it'll give you a good idea about whether you agree, whether you think that this business will use your money wisely, and whether it'll be, a force to be reckoned with in the future. So really, I suggest.
Okay, Dina, we're going to try and give you. Dina, we're going to try and give you voice to see if this works. In the meantime, Omar, one more question about valuation method. For a company just started a year ago. Oh, Dina, we've got you. Go ahead. Can you say that one more time, Dina? Yeah, Dina, just type your question into the box. We couldn't hear you, unfortunately. So going back to the last question, Omar. And after this question, guys, we have one more section. So we would, if you could save the rest of your questions for the final Q&A, that would be great. So Ala has a question for a company just started a year ago and just started a couple of sales and got self-funded earlier and first fund from an incubator. So post-money value is identified. Which method do we need to follow?
So everyone, for the answer to every question asking about which method to follow is as many as you can possibly find. Because remember, the bottom line is that no one method will give you an ironclad valuation that every investor would agree to. What you're going to do is to find different methods, take look at what each of them tell you, have a lot of reasons for why you're saying you're valued at that much, and go to your investors and show them. Tell them, for example, oh, my DCF values me at this much because this is my future projection. This is what I plan on doing with your money. There are these 5 companies that are similar to mine that were valued at, let's say, $5 million each, and my Berkus method says I'm worth that much. Therefore, I think I'm worth X. So really, the answer is as many as you can possibly find.
All right, Omar, let's proceed with the remainder of the presentation, and we'll take the remainder of the questions in the 4th Q&A session.
All right. So just moving on quickly is let's talk about what you can actually do now that you're armed with the different valuation techniques. You know roughly how it works. How does this help you as an entrepreneur or as an investor looking to value businesses? Now, as you've heard me say multiple times now in the Q&A, the best thing you can do is to combine as many different methods as you possibly can. For example, if we're looking at this one, let's say DCF says you're $1 million, multiples at 750, Berkus at 1.5 million, and duplicates at 500,000. Then just take an average. Say this is what I think I am, and these are the methods. These are the many reasons why you, Mr. Investor, should agree with me. Another really important point is that you want to tell a good story. Now remember, investors they're human too, and they just want to be a part of your business. They want to. That's why they're listening to your pitch, presumably. An evaluation is really only as good as you can sell it. You want to take the investor on a journey. You want to tell them that with their money, you're able to accomplish so much. You're able to expand to Saudi, expand to Jordan or Dubai. You're able to really that their contribution, their investment, will be able to take your business to the stars. And that's the most important thing. That's what it boils down to at the end of the day. Just that meeting, negotiation, or that video on Eureeca. It's how well you essentially pitch your investment, pitch your company. As a final takeaway, really what you want to do with evaluation is to be reasonable. Now, value comes with the investment. Even if on paper, let's say you come up with evaluations that say you're worth $5 million, if no investors agree with you, no, they're not going to invest, and you're not going to receive anything. If you are worth what the market says you're worth, all these methods that we talked about, every method that you will ever hear about valuation is simply a method to just to give you an idea of what to say when you're in front of that negotiation meeting. Really, valuation, as another point, it's not the only thing that comes down. It's not the only part. The price itself is not the only part of an investment. There are a lot of terms. For example, you can offer a board seat to an investor who really wants to be with you in the who wants to be with you in the company, and that could help your valuation as well. Are there any questions?
If anyone had a question previously but didn't have the opportunity to ask, now's the time. And these questions can be related to any aspect of the presentation. We have a number of people typing away furiously in the comments section, so just a second. People type away, Omar, I think a question that I think people might have for us is, does Eureeca assist in the valuation process? Does Eureeca valuate the companies that are on the platform?
Excellent question. The answer to that is that, well, no, we ourselves do not value your company. We don't literally do that for you. What we do, however, is provide you with a lot of assistance, such as various templates, like the one for the DCF that I briefly went over. We provide you with various techniques. We recommend which techniques to use, which is all of them, by the way. And what we do most importantly is that we recommend a lot of third parties who can do that for you. The benefit of having a third party value your thing is just that you have someone else standing behind you and fighting for your numbers along with you. Because the disadvantage of being an entrepreneur when you're valuing your company is that an investor will automatically assume that you've overvalued, simply because it's your baby, it's something that's really close to you, and you automatically think it's the best thing in the world. You might not be wrong, but an investor will automatically discount anything you say. Discount, not ignore, which is a very important distinction. So to summarize, we provide a lot of support, but Eureeca does not value companies. Excellent question.
Okay, so we have a question about DCF, Omar. On DCF calculations for investors, would it matter if the management compensation and benefit is considered as one of the high costs of the business? What is your advice?
It should be considered, it should be one of the costs there, because it's essentially going out. And the idea, it's not necessarily a bad thing. I, as an investor, could be very happy to hear that you're planning on compensating your managers quite well based on their performance. But to answer your question, yes, it should definitely be considered. And it matters as well, because when you reduce your costs, you reduce the cash flows and therefore possibly reduce the valuation.
Okay, a question from Alat. How to count other factors or consider other factors, like establish new sales channels, parentheses partners, or a lot of people download for trials. One of the giant IT vendors recommend the solution. How to factor in these within the value?
I would potentially count those as relatively intangible assets, as in you have a large database, you haven't capitalized on it yet, but for example, you have 500,000 users who are clinging to your every email, who use your product regularly, and that's quite a high value. So what you can do is you could possibly add it as goodwill or an intangible value if you're doing DCF, and give it quite a high rating with the purchase or the cost to duplicate as well.
Okay, Omar, a question from Harish. Are businesses early stage or otherwise that come on Eureeca, do they have to report to their investors financials?
I'm sorry, could you that?
Harish would like to know if businesses that are on Eureeca are required to submit quarterly, half, yearly activity and financial reports to their investors? Is this not mandatory or mandatory?
So what happens on Eureeca is that entrepreneurs are required to submit a term sheet, which simply it's a document stating that these are the rights that the entrepreneur intends to give their shareholders, which goes back to the last point I was discussing earlier, that the rights or the terms that you give an investor are a heavy part of the price as well. For example, if I'm getting more rights, I'm likely to accept a lower valuation and vice versa. So when it comes to earnings, I believe that's the information right that's offered in the term sheet. So it depends on each entrepreneur. Some will say, I'm planning on giving quarterly reports. Some will say I'm giving annual reports. Some might say I'm not giving reports at all. So it's very important when you're investing on Eureeca to go through the term sheet to look at the rights that specific investor has given you. And if they promised you quarterly rights, then they should be giving you quarterly rights, yes.
Does anyone have any last questions for Omar? Okay. If a company is in country A and willing to move to another country B to be closer to its clients and needs investment for that, should the valuation be done according to the country A or country B, assuming that salaries are not the same, etc.?
So that would differ depending on the valuation techniques you're using. If you're doing a DCF, which is, I'll remind you, more looking at potential and forward-thinking statements, but uses historicals to validate and prove what you prove your numbers essentially. You would look at country A, which is the country you came from, as a proving ground. You would say, I accomplished this much in country A, therefore, when I move to country B, I'm going to be accomplishing that much. And it will just provide an investor with more validation. Now, having that track record in country A means that I'm much more likely to believe you'll be successful in country B than if you're just starting from scratch. So it is very relevant, and you should definitely include it in any calculations you're using.
If no one has any other, oh, here we go. If a company acquires a partner and requires the investment to meet the demands of the partnership, should it consider the potential sales of the partner company in its valuation?
So what I understood is that if a company acquires another company, should it calculate the sales of the previous company in the valuation? And I mean, really, yes, because remember, you're using various methods to calculate this. So even if I wanted the company for just partnership, the company that I'm buying might come back and counter and say, well, our company is so much more than just the partnership. You're going to have these many clients, you're going to have these many sales, we have a great track record, therefore we should be valued at more. So I mean, the company you're acquiring will definitely fight to include its sales, as they should, because it shows that they've accomplished quite a bit, and they should be proud of it. Evaluation is very holistic.
Evaluation is holistic, right? It's not. Okay, final call for questions. Okay, this will be the last question. It's from Hassan. So normally, how much equity does an investor seek if a pre-launch startup wants something like 50,000 USD as seed/angel investment?
It would really depend on the investor. For example, a lot of incubators and startups, like I know a few in Jordan, would say that, well, for an investment of $50,000, our average standard is to seek 15%. And that tends to be the ballpark. Like in angels, investors tend to like numbers between 10 and 20%, just because it's a sizable stake, but it still leaves enough equity for an entrepreneur to run the business. And it's important for the entrepreneur to have that control, because they're the ones who are going to be really taking the business to the stars, hopefully. So I mean, that is the average, but really it depends quite heavily on the company's performance, on how it's done, on things like the Burkus talks about, the management team, the product development, all these rather important factors. So there is no exact answer, but it does tend to be around 10 to 20%, I'd say.
It would really depend on. Well, that does it, everyone, for our the second installment of our Eureeca webinar series. We'd like to thank everybody for oh, we might have one last second question. This is from Harish again. Why don't startups coming through Eureeca not declare the actual price per share plus premium they are charging, like is done when companies come out with IPO?
Well, Harish, it answers in your question is that within your early stage business, you don't really have the price per share because you don't know how many shares are in your company. You're issuing more shares. You might be setting up, as in the case of Eureeca, you might be setting up an offshore company that's going to be a holding vehicle for all the investments. So usually it's set as TBC, I believe, through a lot of Eureeca startups, just because the entrepreneur doesn't know. He's going to decide, he or she, excuse me, are going to decide what this number is based on how many investors they have, the size of the investments, any other factors. So when you're that early age, you proceed with what you have. So you might not have that information ready. However, if a more established business comes along, that price would usually be declared, as is the case with some companies like Eureeca.
Now the questions are flowing in, Omar. Okay, well, that's just well wishes from everybody. So just once again, thank you for attending. And we hope that you guys can join us in a few weeks' time for our third webinar, which will be led by Eureeca CEO and co-founder Chris Thomas. He's going to be focusing on demystifying the investment process and giving some insider tips into investing. Before you go, I would ask you all to just take a few minutes to, not even a few minutes, just to answer a 4-question poll quickly, just so we, as I said, we can make the process a bit better for moving forward. We appreciate everyone for attending. Thank you so much.
Thanks, everyone. Take care.